Hi, this is David Skrika, editor of AddictedToProfits.net. Many of you know me through Mike Swanson, Wall Street Window, and the podcasts and videos that we do together. Now, for those of you unaware, from time to time, I allow Mike to do a special offer of my newsletter for his subscribers, and this one is going to be a very special offer, as you can see. But in this presentation, I'm going to explain the details of the offer, plus how Addicted to Profits, more importantly, how Different Profits can help you make money in the markets. As you know, Mike is a market timer and trader, and I tend to be more of a long-term investor and big picture investor, and look at and global investor. And I think you'll see that our two forms of investing, Mike's technical style, mine maybe more fundamental and cycle style of trading market cycles, go off each other quite well. What do you get when you subscribe to Addicted to Profits? Basically, I have many multi-tiers of the service. We have 20 issues a year. We have weekly email updates, which we call email alerts about the markets, more of our shorter term outlook. The main issue tends to be kind of the big picture view of the markets. We have a weekly technical wrap and podcast. Again, we tend to, in this technical wrap and podcast, we talk about the technical signs of the markets. We show it in graphical form, and I also do video and audio overviews on top of this, so we can kind of take you through how the markets look technically. We do video updates. So when I do interviews with Mike or do them at my place, I give you also video updates. For example, last year I gave a lot of special video updates and audio reports, as you see there at the bottom, on the markets bottoming, and I suggested sectors to buy, etc. So when we see fit, we will give updates such as these. We also do company overviews, and we also do company overviews and updates. We do that basically on a bi-weekly or monthly basis as well. We have a watch list of companies. So that's a lot there, and for the price that we're offering this, it's pretty low. Like usually, I would say that service. So on top of this and regular Addicted to Profits, we are gonna do. I'm starting a couple other services, and for this time only, we're going to add these services and add-on bonus. StockChartOfTheDay.com, which is 4 to 5 technical charts a week. The International Contrarian, a new service I'm starting, which has a monthly newsletter with commentators from Australia, India, Hong Kong, China, United States, Canada, plus many more countries. This is going to give us a global perspective of investing and help us find global opportunities in investing. If you were to subscribe to all three of these services separately, it would cost $1,000 a year or nearly $100 a month. Well, this time in our one-time offer I'm doing through Mike, and this is $35 a month, and this is also our last monthly offer. After this, we're only going to offer my newsletter to the subscribers on a quarterly basis. And all of this, I don't see, like I said, all of these new services we probably won't even do in our future offers. So this is kind of a one-time thing, and at the very least, I won't do this for well over a year, adding all three services for the prices. So what do we do Addicted to Profits? Basically, I'm all about trends. I'm all about the long-term cycle and long-term trend and how to make money from that trend. Right now, I'm just finishing off a new book as I'm doing this PowerPoint on coming trends in the market. And this is going to be published by Wiley Publishing, a major publisher in the United States. And basically this book is all about trends. What do we see going forward for basically the next 5 or 10 years? And basically what I'm bullish on right now is I believe that commodities, precious metals, and emerging markets are going to be in an upward trend over that 5 to 10 year period. And I think there's still the places to be. I think we're in the we're in the middle of the cycle right now. Yeah, we don't have the dirt cheap prices that we saw in 2000, but we're still fairly early in the trend. And also what I'm going to show you is that every decade there are a couple trades you can make, and if you place these trades at the beginning of every decade, you would do quite well. And we see a new trend or trade of 2010 emerging here. So markets move in cycles. It's not just markets don't have random moves. They're actually very specific 10 to 20 year cycles that markets trade in. And what we try to do at Addicted to Profits is find that long-term cycle and trade within it. So what I do is that sometimes stocks or I guess a sector in the long-term upcycle will get cheap. So it's not just like you buy the beginning of the cycle, hold for 10 or 15 years. You'll have opportunities to trade that cycle and opportunities to buy the stocks that are still within the long-term uptrend cheap. Such as was the case in many gold stocks in 2008. So what we do on top of the long-term cycle, we're going to show you examples of how we've done this, is trade within it to maximize profits. So not just buy and hold, but also to trade within the long-term cycle. Then obviously I also try to find individual companies and stocks that will profit within that cycle. Like for example, if the Indian economy keeps booming, there's going to be certain Indian stocks that outperform other Indian stocks. Like for example, maybe an Indian car company will outperform the telecom companies, or maybe the banks will outperform retailers. So that's the kind of thing what we want to do. We want to find a trickle-down effect. We want to find a big cycle, then trade the cycle, and then find the companies that are going to prosper within the context of that upward cycle. So basically you buy at the point of maximum pessimism. This is a great quote by John Templeton, one of my great mentors. I'm an ultimate contrarian, I tell people, hence why I called my international letter the International Contrarian. I bought near the March 2009 bottom. In my newsletter at the time, we were known that it was very similar to the 74, 1938, and 1907 periods, which were followed by strong rallies. Essentially, in all of those periods, you had started a major secular bear market, and we're anywhere from 6 to 8 years or 9 years in that secular bear market. There was a big bust in that period, and that was followed by a 1 or 2 year bull market, and that's what we saw last year. And when many in the summer, say of 2010, which is 2009, were calling the bull market just maybe a bear market rally, we were saying no, this is going to go further, and of course that occurred. So right at that bottom, I did one of these actually very similar PowerPoint presentation to this called 11 Investment Trends for 2009 and Beyond. I recommended the stock of Tata Motors. I recommended the casino stocks, which soared right near the bottom of the market in 2009. For example, MGM, we talked about $2 and went well over 10. Tata, which we talked at 350, is now trading at 15 and went as high as $18 a share. So this is the kind of thing we do. We look for the sectors in the market that are most unwanted, most unloved, most negative sentiment, and they actually, ironically, are the best to buy at that point. So we want to look crazy. We want people to say, hey, why are you buying that? It's crashed, it's done nothing. Because those are the things that you actually can usually make money from. And we're going to show you some examples of this trade in this PowerPoint. Yeah, so basically, again, as I said, markets trade in cycles are long-term trends. 1901 to 1921, 29 to 49, 66 to 82 were all long-term bear markets. Actually, in both the 29 to 49 period and 66 to 82 period, the Dow fell 74% adjusted for inflation. And then 21 to 29, 49 to 66, and 82 to 2000 were long-term bull markets. There were multi-year moves where the Dow moved up hundreds of percent. Same with the S&P 500, obviously. And these trends tend to last 15 to 20 years. And secularly, the top of the S&P adjusted for inflation was 2000. So it looks like we're about 10 years into this trend. And again, these things tend to last 15 to 20 years. As we can see that there was a 20-year bear market from 01 to 21, and the 29 to 49 was another 20 years, and the 66 to 82 was about 16 to 17 years. So again, we're looking at 15 to 20 years, so we're still looking at about another 5 to 10 years of this secular bear market in stocks. So, of course, if there's a secular bear market in stocks, where's the bull market going to be? This is the Dow Jones Industrial Average on a monthly chart adjusted for inflation. This is done by a guy named Stephen J. Williams. It was updated near the crash bottom of 2008. And what we can see, remember, it's adjusted to inflation, and it's actually not on a log scale, it's on a normal scale. So what we can see is essentially the long-term trend of stocks is higher. Actually, the early 80s top, adjusted for inflation, was higher than the 1932 top, and this top here will probably be higher. But what we can see is really interesting. What he's divided this is into specific 17.6 year periods. And what we can see from the top of 29 to what the bottom of 48 or 49 was 17.6 years. Same from that bottom to the next top in 66, same from that top to the bottom in 82, 83, same from that period to the top in 2000. So essentially, that should mean that about the 2017 to 2018 period is going to be the inflation adjusted low for the market. Now, also note 32 crash, 29 to 32 crash, the 73, 74 bear market as you go in there. Note that these bear markets there were a huge bust lower. Now, note that in the second half of the bear market, being like 1932 to 1948, 49, or from 74 to 82, the market kind of just grinded lower or sideways. And to me, it looks like our low in 2009 put most of the inflation adjusted bust in. We were down about 65% adjusted for inflation. Now, here's another interesting note. Note that the market in 49 and in 82, the two major bottoms, had lost about 74, 75% adjusted for inflation. Well, again, the majority of the bust is in if we were down about 65 to 70% adjusted for inflation in early 2009, which means now we have to go by time. You go look at that period of the 40s or the period of the late 70s. That's what I think we're in right now. We're going to be a period where we're going to see decreased volatility in the stock market. The stock market will still be grinding lower on an inflation-adjusted basis, but it's really not a great place to be other than some short-term rallies from here and there. So the question arises, where is to put your money? And this is what we talk about in this chart here is the Dow Jones Industrial Averages divided by gold, another way to track the long-term trend of the stock market. And this goes back to 1980. And essentially when it takes more than 20 ounces of gold to buy a share of the Dow, it means that the Dow is expensive and gold is cheap, and you want to buy gold. And when it takes less than 2 ounces, especially about 1 ounce of gold to buy the Dow, it means that gold is expensive and you want to buy the Dow. And we can see from the early 80s to 2000, the Dow had outperformed gold in a major secular bull market. In 1980, it only took about 1.25 ounces of gold to buy a share of the Dow, and it took only 45 by the time 1999, 2000 rolled around. So essentially, this indicator would have told you to be buying your gold in the late 90s and selling the Dow. And of course, that was the secular top adjusted for inflation for the Dow and the bottom for gold. But what we can see, what's really interesting here is we're not down to that 1-to-1, 2-to-1 area. We got as low to about 7-to-1 in 2009. And right now we're about 9. We've been trading most of the last year between 9 and 10-to-1. But we still have a ways to go. Yes, it means that we're in the middle of the cycle, but it still means that gold is probably still in its secular bull market and the Dow is still in a secular bear market. And if we look at the charts below just quickly, those are charts of the Dow and gold themselves, not just the ratio. And you can see that all through the 80s and 90s, the Dow was on an upward swing, gold was on a downward swing. And then in 2000, the Dow essentially topped and gold began this massive upward swing. And if you were to adjust that Dow for inflation, you would see even more significant top. So to me, this is, again, our long-term secular trend. Gold is still in a major bull market and where you want to be. And our newsletter talks about ways to kind of so this is the gold to silver ratio. This is another way to tracking it. Now usually at a secular bottom in silver, like happened in 1980 or years earlier, 1930, in the early 30s, it only takes about 15 ounces of silver to buy 1 ounce of gold. And then at a secular bottom in silver, it actually takes 80 to 90, maybe over 100 ounces of silver to buy 1 ounce of gold. Silver tends to outperform during the massive bull markets. And we can see the same thing. We can see that silver fell faster than gold in the 80s and 90s, and it went from taking only actually 15 ounces of gold or silver, 15 ounces of silver to buy an ounce of gold in 1980 to over 100 in the early 90s, and of course, it was still over 80 in 2002 to 2003, and that's come down somewhat. It takes about 68 as we write here, but again, this is again an indicator telling us that if it only takes 15 ounces of silver to buy an ounce of gold at a secular top for both, but we still have a ways to go here. So it just tells me that, again, we're in the midst of the bull market for precious metals. And it also tells me that if you can take the gut-wrenching volatility of silver in the longer run, meaning 5 or 10 years, you actually want This is the S&P, and again, I'm looking at this long-term trend here, and you can see these secular bull markets really perfectly in this form. You can see the big bull market of the early 80s to 2000, that big uptrend. You can see that it's kind of, that first of all, that big uptrend line was actually broken in the '02 bull market, and then we've kind of been trending sideways since, losing value on an inflation-adjusted basis. And again, silver and gold are below. You can see they were flat during the S&P bull market, and then have turned higher in the 2000s. So this, if I'm correct, that this sideways trading range should probably still occur for another 5 to 10 years. And as silver and gold, as we can see in the long term, have been counter to the market, they should continue to move higher in the next 5 or 10 years. So again, this just shows this long-term trend very clearly in graphical form. We had an 18-year uptrend. We've now been going sideways for 10 years, and that should probably continue for another 5 or 10 years. And what's really interesting in the last 10 years of these, the last 5 to 7 years of these secular bear markets, inflation really picks up. It happened in the 40s, it happened in the late 70s, it happened in the late teens. So all of that tells us that gold and silver could perform even better. So another secular trend is commodities. Commodities also move counter to the market. Inflation usually takes off in times where the economy and stock market are not doing well. And this is the CCI, which is a commodities index. Again, we can see from the 80s and 90s, this essentially was moving sideways, had a big breakout in 2005, 2006, had a bit of a blow off in '08. But again, we should be moving higher. And obviously that decline in '09 was actually a great buying opportunity. I think in the short to intermediate term, we might go sideways in commodities. But again, I believe this is part of the long-term secular play. We're just in the midst of this, and we should use weakness in commodities to actually buy them longer term. So what our newsletter does is we talk about weakness in commodities, which commodities to buy, what to buy, when to buy, how to take advantage of weakness that happens in a long-term uptrend. Well, another a way of doing this is we take ratios. Like, for example, this is the HUI, the AMEX Gold Bugs ratio, divided by the price of gold. And what this essentially shows, what those blue lines are, show you when the HUI is cheap compared to gold. Because during downtrends, gold stocks fall faster. During uptrends, they rise faster because they're more leveraged to the price of gold. So what we can see is that since the bull market started in 2000, whenever the HUI is trading under about 40% the price of gold, which happened in 2000, it happened in early 2003 and all throughout the second half of 2002, it happened in 2005, and of course happened during the crash in 2008, it's been a great buying opportunity. The HUI went down to about 40 in 2000, and then rallied to over 150 in 2002. And then it fell back to roughly 100 in 2002, 2003. And gold stocks again became cheap, and then you could have bought there, and it rallied to 250 in 2004. Gold stocks again became cheap in 2005 as the index fell under 200, rallied to over 500 in 2008. And then again, when the market crashed, gold stocks got as cheap as they were since 2001. And you can see that was a great buying opportunity. The HUI fell to under 200 and then rallied right back to its high by late 2009. So again, this is a way that you can gouge if gold stocks are cheap. And sometimes it's more important is when you buy, not what you buy. So you have to be very patient. You see that this, if you're using the 40% range, you can see gold stocks did not get cheap again after 2005 for another 3+ years. So if you're willing to have that kind of patience, our newsletter will show you how to do this and how to take advantage of that. And if you had just waited and not bought those higher prices in '06, '07, and we actually wrote an article in late 2008 called Buying Opportunity of a Lifetime. We talked to that. We thought the great gold stocks are absolute fabulous buys in late 2008. And as noted, the HUI index more than doubled after that in just a few months. So this is what we're talking about with buying weakness in the long-term trend and maximum. So our next chart is actually Freeport-McMoRan, copper and gold. Same thing here. I just want to show you that again. Notice when the gold stocks and copper got really cheap compared to gold in late 2008, late 2009. It was a great buying opportunity. We actually put Freeport Copper on our list at around $30 a share. We were a bit early and it fell to about 17, 18, but we're telling people to average under that time, saying it was extremely cheap, and of course the stock took off to 90. So again, this is all about being patient. It just shows you the kind of opportunity you can have. You can see Freeport has had a big uptrend from $5 to to about $76 where it is today in the last 10 years. But again, like if you were just patient and waited for that weakness to occur, you could have a great opportunity to buy it in 2008, 2009, early 2009. The next chart we had is the S&P 500. And again, what I want to show you from this chart, this is how you trade a secular bull market, okay? The S&P, as you can see, started a bull market in 82 and lasted until 2000. We're showing the bull market. And what we want to show you is that in the secular bull market, you have to have a different time frame to set. You have to know, if you would have known that the S&P was going to start a 15 to 20-year bull market, you would have known all the dips, 1987 crash, the 1984 correction, the 1990 correction. These were all great buying opportunities. You should have been buying on the dips back then. So, and that's what we're talking about, what we saw last year with gold. If you look at the 1987 crash, where the S&P fell from just about 338 to 216. It looks like just a tiny blip on that massive bull market. And I think that's what the commodities market of 2008 is going to end up going out 10 years from now when we look at the top of this commodities market. So the S&P 500 is looking very good. Looks very good in terms of this is what a secular bull market looks like. So I think this is the way you can learn from this and trade the commodities market like this. Like every little dip in the S&P from 82 to the mid-90s was a great buying opportunity in a long-term secular uptrend. So that's the way you have to look at it. You have to know where the long-term trend is and then take advantage of that short-term weakness. So the trade of the decade is decades. Now, for example, trades can be as easy as putting one big trade on at the beginning of each decade and sticking out that trade. In 1970s, a trade would have been to be long Japanese equities, commodities, and obviously be long commodities, and short U.S. government bonds, which of course had huge spikes and yields from the early 70s to late 70s. In 1980s, you could have done a switcheroo. You could have gone long bonds, U.S. equities, and shorted the commodities or CRB index, and shorted gold, and you would have made out like a killing. The CRB index started the decade at over 300. It ended it at just over 200. Gold started the decade at almost 800 and ended it in the 300 to 400 range. And of course, the Dow began the decade under 1,000 and ended the decade close to 3,000. In the 1990s, you would have stayed long U.S. equities and you would have shorted Japanese equities. A great trade again. U.S. equities, the Dow went from 3 to over 10, and of course, Japanese stocks went from 40,000 on the Nikkei to under 20 during the course of the decade. And in the 2000s, you went long gold and resources, shorted U.S. stocks, especially tech stocks, and of course, the Nasdaq went from over 4,000. Where it was roughly at the end of 1999, actually, I think in the mid 3,000s to as low as 1,100, and of course gold began the decade at roughly 300 and went to over 1,000. So the question is, what I think probably like the 1990s saw a second decade for stocks. The 2010s is going to be a second great decade for gold and commodities. We're seeing massive printing of money. We're seeing massive spending of money by politicians. That's usually very positive for inflation and gold going forward. So that also means that government bond yields are probably going to go higher. So you short the U.S. government bond, go long commodities, gold, and also Japanese stocks are just ending this 20-year down cycle that we've talked about. Just like U.S. stocks, Japanese stocks are seeing it as well. So I think another trade is to go long Japanese equities and short U.S. government bonds. Bill Bonner's also talked about this at the Daily Reckoning. I actually happened to come to the same conclusion and then read Bill saying the same thing. But that looks to me like a great trade here. And we actually have specific sectors that we've outlined in the newsletter in the Japanese market that we think are going to outperform. So not only do you go long Japanese equities, we go long sectors that we think will outperform, and we'll short the U.S. government bond. I think that will be a great trade 10 years from now that we'll look upon. And probably in 2020, the trade will be to go long. So this is just quickly, just want to show you. You can see the U.S. bond at the top. You can see the great 20 years it's had, bottoming at a level of just over 43 in 1981 and going to 142. I think you see that spike there in 2008. I think that is the blow off in the bond. And a note below that during that 20-year period, we can see the two charts below are the yield of the bond, which went lower for 20 years, and the Nikkei, which after peaking in 1980 has basically gone down. So this is the Nikkei here, and again we can see this downward move in more detail, and it looks exactly the opposite of the bond in the last 20 years. You can see the blow off from 83 to 1990, and then the big crash since, with Japanese stocks losing nearly 80% of their value in the 19. So the next one, this is really interesting. This is the Nikkei divided by the U.S. bond. Again, this just shows you how cheap the Nikkei has gotten. In 1990, at the bubble top, it took 520 units of the U.S. bond, meaning you would have to own 520 units of the long-term U.S. Treasury to buy 1 unit of the Nikkei. In 2009, you only needed to own 55 units of Treasuries to buy 1 unit of the Nikkei. So this basically meant that the Nikkei, compared to the U.S. bond, lost 90% in those 20 years. And again, as Jim Rogers would say, when you're investing, sometimes you have to think to yourself, how much can it go down? Well, the bond's already lost 90% of its value. And even where we are today, we're over 80% lower. The Nikkei, lost 80% lower compared to the bond. How much lower can it go? Not much. Going long the Nikkei and short the. And then so another trend we really like, for example, are emerging markets. I think that emerging markets are in a long-term secular bull market. I think there's going to be a shift away in the next 5 or 10 years from the United States. But emerging markets are very volatile, and again, it's not what you buy, sometimes when you buy, which is important. So this is where we can help you. We can help you time these things. This is the Bombay Stock Exchange going back the past 10 years, and you can see basically an uptrend. Doesn't look like a bubble though, which is a nice solid move higher. And you can see the big dips in the 2001 bear market, in 2004 when they elected a more of a socialist type government. When there was a small correction in the U.S. markets in 2006, this actually fell nearly 30%, again more volatile. Then of course the bust last year, when we aggressively recommended emerging markets in early last year. So again, this is again the example of when you're in the long-term secular bull trend, you buy these declines. And our new so the next chart is Tata Motors. Again, what you buy sometimes, what and when. And so we like Tata Motors. I like the story. I like the Nano, the $2,500 car they're releasing. I thought there was a lot of pent-up demand in India for it. Plus, I thought the stock was undervalued at the time. So I recommended it at $3.50 back in March. It fell as low as $3, and then of course you see this huge run-up. So again, even as well as the Indian market did, Tata outperformed the Indian market. Again, this is kind of what we do. We try to find these kind of companies to profit from trends. And again, look for them when they're beat up. And we know the long-term trend in India is probably going to be higher. And you can see that little window of Tata there below $5 was a great. The next is land. Again, another example that I'm very bullish on Chile, another emerging economy I'm bullish on. Land, the top airline in Chile and maybe in South America fell from nearly $16 to just about $7, and one of the very few airline stocks breaking out to new all-time highs in late 2009. I actually didn't recommend this, but this is an example of, again, buying quality companies in long-term secular uptrends and what they can do. And land looks a little overbought here, and if it does see another decline in the next few years here, again, would probably be another buying opportunity. So picking out things such as these. So again, I'm going to just end off here. I hope you've enjoyed this little presentation. I think we've outlined pretty well our long-term secular trends, how we can help you trading those trends to maximize your profits from that. So again, our special offer is Addicted to Profits from the monthly. an international contrarian for the monthly, stock chart of the day for the monthly, and all three for the price of one, $35 a month. So please sign up today for this offer. This is going to be our last monthly offer through Wall Street window. After this, we're only going to do quarterly offers, so we can see this is a pretty good deal. And I hope that you do join the Addicted to Profits newsletter and you enjoy our